Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, good morning, Jim. Good to be with you.
What's happening on the bond front? I know it never makes the headlines, and yet it affects our mortgage rates and so on.
Oh, yeah. Market cap of bonds is huge. Bigger than the market cap of equities. And but as you say, the stock market gets the headlines, even in the great financial bubbles in history. The first one, 1720, called the South Sea Bubble. Why is it called the South Sea Bubble? Because the premier company at the time was the South Sea Company. That was the focus of promotion. And onwards, and you have this peculiar condition whereby the equity side, those involved either on the buy side or brokerage side or money management side, they kind of look at companies and management and earnings. And then they look at the Fed, because the Fed is there to guarantee you that whatever they do will be made right. And there's a whole lot more to equities than that, because you have this thing called a stock market. And this thing called a stock market is very cyclical, with bull markets and bear markets. And on the bear markets, they all go down. And it doesn't matter which horse you're backing and how brilliant the management is and how sound the balance sheet is and all that sort of stuff. When you're in a cyclical bear market, they all go down. So, and the hinge on the change from a bull market to a bear market is usually found in the credit markets, which is the interest rate market. And so we look at that, and again, there's another big irony there, because most of the street believes that the central bankers, and let's stay in the big market with the Federal Reserve System, can set interest rates at will. But we've seen it throughout history that this isn't the case either. So here's the nub of it is that where a central bank can lower interest rates for a while, and at this time they've put in a massive effort to lower long rates, but if long rates didn't want to go down, they wouldn't go down. So, but they, throughout history, they have no influence on the credit markets when it's due for a change. And by that I mean you've got the credit spreads, which is the quality market. That's the difference between high-grade issues and low-grade issues. And when you're in a cyclical party, confidence is there and risk is not there. So they reach for the yield and buy the low-grade stuff, and that narrows the credit spreads, and that's a sign of the party. And in looking at those, we've been following CCC, which is just barely junk, relative to treasuries, and it got trashed last year with crashing oil price and a moving up dollar right down into January, February, and credit spreads widened right out to something that was 21%. And then you've had the rebound out of there. You've had friendlier crude oil prices and more enthusiasm around. You've had central bankers buying not just corporate bonds, but also buying equities. So it's been a good party. And our look at the credit spreads, since July, we've said this thing is a runaway market, and in which case the only thing that you can sort of hang your hat on would be momentum, and that the weekly RSI on that would come into about 25, and it came into the 24 here and is still narrowing. So we've reached that on spreads. It's also, we've got another technical tool called a sequential buy. In this case, it turns around. And that is beginning to engage. So the narrowing has been terrific, absolutely outstanding, but it's reached excesses from where it can reverse to widening, and this isn't good. And it's also interesting that on crude oil, we've got technicals on that one that say the rally has just about done it. You've had momentum and pattern there that suggests that the crude oil market is getting ready to reverse and head down. So it's interesting that you got the two things that are kind of leaning on each other, both reaching excesses enough to suggest a reversal in those. And then the other one in the credit markets, there's a difference between long rates and short rates, and that's called the yield curve. And it does certain things during a boom, and it's done that for, about 14 months until the middle of summer, and then it's trending the other direction. It took a good rush and backed off, checked it, and then is now starting to, on the move, which is called steepening. Now, with a steepening curve, it can help the bank stocks for a little while, but when you've been in a big party mode and steepening continues, it's a sign that you're going into a credit contraction. And we have one other item in this way of looking at things, and that's the old friend, our gold-silver ratio, and we like to call it the metallic credit spread, and it does something similar where to ordinary credit spreads is during the good times the ratio between the difference between gold divided by silver comes in, gets smaller, and then when it gets ready for the party, reverses, and it came into 65 in June and has been widening since. It's sort of out to 72, and that's just on a breakout. So if it breaks out beyond, let's say, 74, then it would be saying that the financial markets are heading to trouble again. So then what we also want to do, Jim, is just plain look at what the interest rates are doing themselves, like long-dated treasuries, which is when you're speculating, that's the place to be. The longer dated out you get, the better the bang you get. And they reached a peak in July. It was pretty good. They had upside exhaustions and pattern and all sorts of things, and it was one of the most technically excessive peaks in the bond market for a long time. And it's been checking down in price since, or let's put it this way, interest rates going up. So if these rates go up far enough, of course, there's a link between mortgage rates for residential and, well, actually mortgage for commercial too, and the interest rates in markets. So it'll put some pressure on interest rates, on the mortgage rates. So if people are thinking of locking in a low rate now, it should be done. I don't know how long to lock it in for, a few years anyways. But the declining rate game is over. It's been over since July. And that's for the high-grade stuff, long-dated treasuries and long Canada. And the party in low-grade stuff, junk stuff, continued on until August, and it now is reversing. So while the world is full of comment about zero interest rate policies and all that sort of stuff, market rates of interest are going up. And this is where it becomes ironical, because you've got a large portion of the advising community hanging on what the Fed is going to do to interest rates. So we found that throughout, since the 1840s, England was the senior country then, and the Bank of England was then allowed to be much more easy, or they allow interest rates to change much more than prior to that. So anyways, what the record is in the senior central bank, and when you're in extremely volatile markets like we've been in, that the senior central bank will be 4 or 5 months behind changes in market rates of interest. So if what you have now is market rates of interest going up, like LIBOR, since May, since November a year ago, they've been going up for a long time, the central banks are behind that. They're sort of talking about raising rates, and of course, they're really in an awkward position, because I think they're finally discovering that their theories and practices are not working. So anyways, so the irony is that the world is focusing on what the Fed is going to do to interest rates, when in reality, it's market rates of interest that do it to the Fed. So there is absolutely no point anybody at any time ever debating on what the Fed's going to do to interest rates, because whatever it does, it'll be behind the market. So at some point, probably in the next few months, the rise in interest rates that has already started will be enough that it'll force the Federal Reserve and the Bank of Canada to raise their, what we call, administered rates. So, hey, this is a good subject, it's timely, and the next couple of months are going to tell quite the tale.
We'll have more with Bob Hoye right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, the federal government has said banks should take on more of the risk for mortgages. Is that a good thing to do?
Oh, I agree with that, yes. Oh, they come in with ideas. I don't know when that one was, but it was a long time ago, when perhaps some economists in some department in Ottawa decided that the economy should be better. Therefore, we'll do things to help the economy. That's an arbitrary decision. And they ended up with having insurance-backed mortgages and, the government effectively backing the thing. And no, it should not be doing it. And I'd get rid of that one soon. And I know recently they're urging people, house buyers, more of a larger equity into the scheme, but it always used to be something like 25%. And they've are wise in trying to instruct people to be careful in a highly speculative property market.
Oil, you said it seemed to be finished with its run or very close to it.
Yeah, it was great, because when it crashed down to 26, we had a target the year before of 27, which turned out, actually it was either a one-third correction, which would have been 37, or a quarter, which turned out to be 27. It turned out to be 27, and actual low was 26. So then, of course, you were ready for the rebound. I mean, the technicals were pushed virtually to the limit, and now we're up there. You also have, you can have a nice little seasonal firming in late September, early October, which we've had, and now it's ready and poised to decline. And this is going to be quite messy. You know how it's beat up the industry, but it's also beat up commerce that supplies things to the oil industry, and provincial revenues, city revenues, anybody near the oil patch are suffering. And you also have had weak industrial prices include base metals. And copper is just looking awful recently here, and with my colleague we were looking at the other day, and over a long history, copper can go down and test old lows. I think the old low in '09 was something like $1.30 or something like that. So, prices are adverse in a post-bubble contraction, and this is what puts, actually, if you've got basic industrial commodities going down, its influence spreads out further, it seems, because it puts pressure on a whole lot of prices in commerce and industry. So when you have pricing pressures throughout many businesses, they're not making much money. And then as commodity prices go even lower, they're making less, and then they find that they're hard to service their debt, and then the rating agencies get interested and start downgrading. And of course, this is easy to see in the direct link between crude oil prices and problems within the oil industry. But those are not limited, where you have weak crude prices and a weak oil industry. You also got weak base metal prices and weak there. Mind you, everything had a terrific rally out of the disaster of January a year ago. But all of this is, the best is in, and we're looking for it to go all down and test, or could get pretty close to the lows seen last January and February. And we should be best prepared for another slide in prices.
What about the precious metals? I know they've had a correction. Is this the kind of time of year to be taking a look at maybe snap up more with a lower price? Yeah,
we're here now. Going back to July, when the excesses on the upside were fully expressed, and we had the technical readings on those, and called for we call it a significant correction in the cyclical bull market in precious metals. And the initial view was that we could have a decline in the gold stocks of 20% plus. I think they're down about 30%, oversold. But now you got a problem with the big stock market. It could decline. So if this financial storm appears, by year end, then you got a liquidity crisis, and the people are not going to be able to be too eager about buying gold stocks when the rest of the market's under a lot of pressure. Now, also, if there is a liquidity crisis, the wise money will go not to try and make money, but just to be safe, and that means you got to go to the most liquid items, and that, of course, gold has very good liquidity relative to many things. And then the other where you have the most liquidity is in short instruments in the senior currency, and the senior currency still is the U.S. dollar. So you're going to have a good bid in a storm for gold. The investment demand will increase. But at the same time, the flight into U.S. dollars will support the U.S. dollar. You could have a firming dollar and increasing demand for gold. So maybe in U.S. dollar terms it won't rally too much. But if you're in other currencies, which would be weak relative to the U.S. dollar, then you'll make some money out of gold. But the point in owning gold anyways is not to make money, but to have it there for insurance. And the point of trading gold stocks is to make money. Now, I mentioned a while ago the gold-silver ratio, which is close to doing a breakout, and we'll advise when it does break out, because this thing, and many people in the gold industry, let's call it that, the comment and forecasting side, gold bugs, never stop to look at what the gold-silver ratio does over history, and it becomes a very good indicator. So if it goes up a little more, then it's going to be saying the financial storm is quite close. So this is a very interesting time to be looking at the markets, Jim.
Bob, I know you'll keep a weather eye out for us.
I like that one.
My guest has been market historian Bob Hoye, the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet, our YouTube channel, Talk Digital Network. Questions for Bob can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.